The credit amnesty, whereby credit bureaus will have to remove adverse information on clients where the bad debt has been repaid, will kick in on the 1st of April. The National Credit Amendment Bill has been criticized by many credit lenders because they believe the more stringent affordability measures the bill contains may promote informal lending. Informal lenders offer no protection for consumers.
You could break the amendments up into two, really. So the one at hand currently is obviously the credit amnesty bill that's coming into effect next week. And as you said before, in 2 months' time it will be in effect practically. From where we're sitting, we don't feel that there's any reason to panic. We don't think it will affect our business as heavily as it may the banks and the bigger micro lenders out there. And that's particularly for one reason, is that we are not as heavily reliant on credit information to make our lending decisions as the banks are. I would say only about 20 to 30% of our credit lending decisions are because of credit, what we derive from credit information. We use other things like behavioral, on the website, behavioral information. We've also analyzed our data over the years. I mean, we've dealt with hundreds of thousands of consumers, and that data has told us a story. For example, we know that in the Northwest, if you're male by the age of 35, you're more likely to pay a loan than if you're coming from the Western Cape and you're 21 years old. So we've used various innovative ways within the platform to get out to our lending decision. So in terms of our business, in terms of one alone, won't affect us too much. I think it's a good bill for the consumer, and I think that we are definitely supporting it. Well, One Alone is the only online payday lender that actually still speaks to its customers. Other payday lenders have taken the view to have 100% automation, which means that from the time they grant the credit to the time they pay out, they haven't actually talked to their customers. What we've decided to do is to swim a bit against the current, and look to speak to our customers. So after every application, before we pay out the loan, we phone the customer up. We would speak to the customer about his agreement, make the customer understand about what the costs of credit are, when the repayment dates are. It's also just our last layer of fraud prevention to make sure we are lending to the person that has applied to on our site. We do believe that in terms of online lending and the move that technology has made within the industry, that it's allowed consumers a good user experience where they can go online within 5 minutes, get instant gratification to know that they can access credit or not. If we now take away that ability for consumers to get that instant gratification, where we now have to collect documents in order to verify employment, in order to verify what they can afford, etc., it will take us, I think, back into an era where customers may move back into informal borrowing, and that's what we're afraid of. I think the consumer will be at the detriment if that particular Affordability Act gets implemented. So my recommendation would be one of two things to the regulator. Either scrap it, as I've said, or look to rather segment the market. So look at short-term credit agreements, where that's the space we play in, where there's less risk to the consumer, and have the current affordability assessment implemented, or carry on with that. And then the longer-term agreements, vehicle finance, bonds, mortgages, etc., have more stricter rules around that, because the customers are at higher risk in terms of those agreements. But I think, it's something that they will need to have a look at in time.